Okay, so look, we're in the final sort of segment of these ISLA sessions. Quite a fascinating series of discussions, particularly around securities lending, with a high level of ESG content, as you would expect. And the session from Stephen also was very, very reflective and thoughtful of the key challenges. I'm just joined in this last session by Xavier, who was part of the panel earlier, but also very importantly by Sarah Wilson from Minerva. Sarah, listen, I'm going to come straight to you as we go into this final session. A lot was talked about asset stewardship. The issue of voting's bobbed up and down in many discussions. Xavier and myself will confirm that, we've had many discussions with many clients about voting. Listen, what are you seeing and hearing from your clients about stewardship voting and how that's interacted with the ESG debate? I mean, is it overplayed, or is it something that we need to get right?
Thanks. That's a really good question, because the whole issue around stock lending stewardship has been a little bit cyclical, actually. About 10 years ago, there was a very big debate about what was called empty voting, when people were suddenly realizing, oh, if I'm lending my shares, I can't vote my shares. And there was sort of a lot of arm flapping about it at the time, but not much happened. So I think the ISLA guide on sustainable stewardship and securities lending has actually been very helpful in bringing that back front and centre. We've had PRI also now picking it up as an issue, in addition to the work that the ICGN did a number of years ago. So I think that what we're seeing is there is this focus, which is incredibly concentrated now on the asset owners. Previously, everything about governance or ESG was really trained on the fund managers. Now it's the turn of the asset owners to ask better questions. So I think we heard earlier people talking about the need for initially better reporting. There was a lack of transparency. We heard about people saying, we're going to do more training. And that's to really bring awareness to people that you don't have to do what GPIF did, which is just suddenly abandon stock lending in its entirety. You need to manage it. And so you need to manage it sensitive to these new issues that you're now thinking about. So actually, I don't think it's overblown at all. I think actually we're just at the beginning of a process of saying to everybody, everybody's thinking has moved on. This is becoming a holistic process. And to some of the other points that were mentioned earlier about interoperability of data, better reporting, making things accessible for people to understand. Stock lending is beneficial, ESG is beneficial. There is no need to stop one to do the other.
So Sarah, I have one further question before I ask Xavier something, but how important, therefore, is it that the industry mobilizes? Because it seems to me that on ESG we're going from concept and design, so there's some really good thinking that's been out there for quite some time, through to implementation. So we're now actually, rather than talking about it, we've got to do something. Would you agree with that?
Yes, absolutely. When regulators finally get hold of an issue, they suddenly realise that something must be done. And I think the biggest challenge here is to make sure that industry participants are actually playing their part with the regulators and helping to formulate regulations and guidelines which are properly informed. I've seen it happen in the past that politicians will do things that get them re-elected, whereas those of us who are working in this industry on a basis, this is our profession, we want to be able to do it for 20-30 years, and it's really in our interest to educate regulators as much as it is the end clients. Sure, there's always bad practices at the margins, which doesn't do any of us any good, that we need to help stamp out. So I think it is now about, to the point also that was mentioned earlier, this is about the industry working in a very much more harmonious way, getting to grips with it, and coming up with solutions.
Just on that point, Sarah, I'm coming to you, Xavier. Do you agree it's up to the industry now to come together to do more in this in a sort of joined up holistic way? I mean, what's your perspective? Because I think when I look at your organisation, Xavier, I'd say that you're at the leading edge of getting it right rather than wrong. I mean, what are your thoughts about some of the things Sarah's been highlighting?
Yeah, so it's like definitely like engagement and voting are quite important when you are a responsible investor. So I would say ESG may have pushed beneficial owners participating in second lending to be more active or to take more control on their second lending program. So that means having a clear policy around second lending, integrate second lending in the voting and the stewardship policies, to be clear and transparent about the fact that you can engage in second lending and still maintain your voting rights. But indeed, I would agree with Sarah when she mentioned about the empty voting. That was a clear concern, and maybe it was ESG pushed beneficial owners in terms of managing better the risk of empty voting. And when it comes to your question about like the industry, yes, I do agree. So we are the asset owners. So asset owners have an important role to play in terms of developing the ESG framework on securities lending and making it more visible about what they do and how they manage it.
So Xavier, and I had one more question for you, which we've seen a little bit, and Sarah alluded to. I think the couple of large institutions have left the lending stage, and that's been, I think, more isolated than widespread for so-called ESG concern. And Morris mentioned it in the past session. But also, even this morning, I'm hearing that there's a sort of a funds association in Denmark that's coming out with some quite negative language around that ESG is not compatible with securities lending. Now, these are things I think that we need to obviously counter. But my concern is, and get your thought on this, Evie, is that if we just had this blanket view that if you've got an ESG portfolio, then you shouldn't lend it. And I understand that's a view. But if we took that view to its extreme, there'll be no market liquidity for anyone to trade anything. So how do you, Xavier, how do you reconcile those views that it's all very well to have a very rigid ESG ethos, and we all support that, but actually you've got to be a bit more pragmatic about actually supporting things like market liquidity and broader capital markets. Any thoughts on that, Xavier, as to how we tackle that quite thorny issue?
Yeah, maybe it's just the first point would be like we also face this type of discussion about ESG and sec lending. So we had some clients asking not to participate in sec lending. So we have ESG label portfolio that don't participate in sec lending. So first is like you have to make your client has to be comfortable participating or not in ESG. So it's again, it's all about how you manage it and how you make it transparent and understandable to your client. Then, yeah, to your point about market liquidity, I think it's an important point. It's the right balance between the supply and the demand. And to the point that were made before in the previous panel, so you see that central banks in Europe, like all the national central banks and the ECB, they have a second lending program, and the aim of the second lending program is to maintain liquidity and avoid scarcity of assets. And what does that mean when you have liquidity issues and scarcity of assets? You have a spread in the widening spread in the bid and ask. You have less liquidity, you have less market transparency. So that has an impact on investors, and that has an impact on your portfolio. So that can't be put on the shelf. So that's definitely like an important aspect to keep in mind.
I think Xavier, and I would agree with you, and Sarah, I think that, I just worry there's a bit of a idealistic mantra around ESG, and what we need is some, if you like, pragmatism around the reality of how we implement it. Any thoughts on that? I had another question for you in a moment, Sarah, but any thoughts on that sort of dilemma of the purist ESG approach versus the reality of getting some stuff done? You're on mute, Sarah.
Yeah, there are degrees of purism on these issues, and there first of all, I'll say there are different approaches to ESG. And there are people who have absolute beliefs that irrespective of the size of the issue, the company should be excluded. And there are those who are much more pragmatic about them. And none of my clients lend 100% of the stock anyway. They always have the right to do a recall and will make a judgment about that. And they will weigh off their fiduciary responsibilities to their beneficiaries against their investment beliefs. And so, for example, they may determine that what they will do is address the ESG issues through engagement. So I think we need to move away from this idea that everything is binary, black and white. There are shades of grey and shades of green. But what we've got at the moment is quite a lot of people not even considering that there's any colour at all. And so, you know, if you're running an ETF which has already got a negative ESG screen on it, then the thing that you should be then thinking about is whether the collateral also meets the test. And so it's about doing that due diligence on it in a slightly more thorough way than maybe has been done in the past. But no, there are no absolute absolutes. Each client will have their own individual approach, and they will say, you know, if we've got a tiny minority holding, and if there are no material issues that are coming up on the agenda, then we're going to leave this out on loan. And we don't have any problems with that. Where it does cause a problem, and one thing that's not been touched on at all, is that the issuers don't necessarily understand stock lending. And they don't necessarily understand why a name keeps appearing or disappearing off the share register. And I think this is an area for comms that is definitely good. Reaching out to the investor relations community to actually explain, no, this long-term shareholder still is a shareholder, it's just that you might not see them on the register. They're definitely interested, and this is how stock lending works. Because it is often assumed that the stock lending is done for nefarious purposes, and that there may be an activism or shorting campaign being mounted against them. So I think we must not forget the other side of these trades, which are the companies themselves.
Okay, I'm conscious of time, and I just wanted to cover one more topic with both of you before I see Nick's already appeared in my screen.
No, but actually the reason why I'm back is that perhaps, if you don't mind, David Weeks and I have one quick question for you guys.
Absolutely,
for you guys,
go for
Andy. I mean, for Andy, Xavier, and Sarah.
Please.
So if you don't mind, I'll interject to use another Anglo-Norman.
As long as we can answer it. I don't want questions we can't answer.
To use another Anglo-Norman French word, because I know that Xavier himself is Norman or Normand, even though he lives in Holland. So he shall be the victim of the question.
Even though he lives in Holland, what's that mean?
I don't know. Whatever. So he shall be the first victim, and then I think David Weeks would like to ask a question to Sarah. So I know that I think you and I, Xavier, were having a breakfast in early December, I think precisely more or less a year ago to the day, or plus or minus one day, when that big bombshell came on our teleprompter or whatever screens from Tokyo, because our colleagues and friends from the government of Japan Public Pension Fund, all of a sudden, in a quite abrupt manner, decided to completely ban most of their security lending. And because of the relative size in the Asia Pacific area, that created shockwaves the world over, including, in London, I think, where we're having our little French breakfast. So I want to ask you rhetorically, that happened 12 months ago to the day. In your personal opinion, Xavier, what has changed in the past 12 months in the field or in the remit of ESG and securities lending?
Yeah. So yeah, no, I fully agree. So what happened since then is beneficial owners engaging more in their sec lending activity, being more transparent in how they manage their sec lending activity, and also making beneficial owners from insurance company to sovereign wealth fund to pension fund to asset managers, communicating more about how they can have sec lending and ESG being compatible, and explaining to the point of what Sam was making about the communication and the education. So because there can be a lot of press about securities lending, is like that the fact that the Japanese sovereign wealth fund quit sec lending, but like you said, it did not entirely quit sec lending. It stopped sec lending on the international equity. That means that Japanese equity and fixed income sec lending is still happening for them. At the same time, you see like other large institutions. I think after like a Japanese fund communicated that they will stop sec lending, PGGM, a large Dutch pension fund, communicated a few days after that they are still engaging in securities lending. So Norges was mentioned, also one of the largest sovereign wealth fund in the world that also participated in sec lending. So, and that was not communicated. I think it's all about also like the communication that is being triggered by such a decision.
And just to add to Xavier's point, Nick, I completely agree with everything he says. And first thing is, although that was an important communicated event by that fund, actually almost the next day, a very large fund in Australia actually confirmed that they were staying in lending, but that didn't get as widely reported because our friends in the press like to report bad news rather than good news. I think to echo Xavier's point, in the last 12 months, we've done a tremendous amount of work with our institutional investor beneficial owner community to develop a cohesive approach to thinking about the issues that were raised not only by the fund in Japan, but by other funds, because there are some important issues we need to discuss. So I think now we've got a much open and pragmatic debate. And I think that, you know, we've moved the agenda on quite significantly in the last 12 months, I'd say, Nick.
Great. Merci beaucoup, Andrew. I'm aware of time because we'll be joined in literally 2 minutes by the great David Zahn from the City of London. But I think that our co-chairman and forum rapporteur, or rapporteur in English, David Weeks, wanted to ask a question to Sarah Wilson, and this is how we shall wrap up today's session. David, the floor is yours.
Yes, perhaps I'll make 3 observations. The first one is that I think Andrew mentioned that the pensions industry is very slow to adapt to this sort of trend. I recall my experience in the urban regeneration industry in the late 80s and early 90s, when what was then the novel concept of PPP came about, polluter pays principles, which was thought to be rather outre at the time because companies were supposed to be concentrating on their returns and not bothering about the consequences. And the PPP was established there. So pensions, yes, I agree very much, coming lately to this. Picking up the comment, what's happened in the last 12 months, I think the views of the Association of Member Nominated Trustees, which I represent, is that not enough has happened in the last 12 months. There's been quite a bit of talking the talk, but actually producing the goods has been slow on the part of pension fund asset managers as opposed to owners. The asset managers appear to have been concerned more with beefing up the margins which their industry has, and not concentrating enough on the wishes of the clients, the asset owners. And the asset owners, I think, certainly are more forward thinking in their social awareness of these issues. But my third point, Nicholas, just you mentioned Brexit, and the Brexit factor seems to introduce a completely irrational aspect to it, in the sense that if you're a Northeast car worker, you have the greatest incentive to remain in the European Union, and yet we have there the biggest vote against doing so. So how does the irrationality of human behavior affect these things? So I think I've got 3, my recap of my 3 things. One is the pension industry is late. Number 2, we're talking the talk, or the asset managers are talking the talk, we're not actually producing the goods. And thirdly, the irrationality of Brexit as an oddball factor. Andrew.
Great. Thank you, David. And I'll leave the last word in 30 seconds to Andrew to wrap up that beautiful session.
Listen, I'd just like to say thanks to all of my panelists, participants and speakers. Hopefully for those of you not familiar with our markets, you've learned something new today. And for those of you familiar with what we do, some of the things we've talked about have reinforced some of the messages and direction of travel. Just on David's point and some of the points about further engagement, if any of you listening or watching this on catch up want to learn more about securities lending, we've got a great website, but also feel free to reach out to me or any of my colleagues and we can help you going forward. I think that's it from me, Nick. So once again, great sessions and many thanks for the opportunity, and I wish you well for the rest of the day.
Merci, Andrew. Merci, Andrew. It was a pleasure to have you with us today, and I must say that it's a great what has happened at the bloody crossroads where ESG and securities lending intersect. A lot has happened in the past 11-12 months, and a lot of work has been conducted by ISLA and Andrew in person. And once again, I'll use it as a transition to David. Bonjour.